Market regulator SEBI recently announced some sweeping changes with respect to public issues. This should have a meaningful impact on the IPO market action. Let's take a look. The first one, NBFCs can no longer fund an individual over 1 crore for IPO financing. This move should bring down the massive oversubscription numbers under the HNI category. This should also ensure more stable and long-term money coming into the IPO market. Also, it should lead to better price discovery on the listing day for a lot of these companies. The second change is with respect to categorization of the HNI segment. SEBI has said that 1/3 of the shares under the HNI category will have to be allotted to smaller HNIs with the application size of 2 to 10 lakh rupees. The balance 2/3 should be allotted to larger HNIs where the application size is over 10 lakh rupees. Also, just like the retail category, draw of lots concept will be applicable for HNIs too. This should ensure a fair allotment to all applicants. The third change is around the offer for sale part under these IPOs. SEBI has said that shareholders having over 20% of the pre-issue holding can only offer half of their holding under the OFS category. Also, shareholders having less than 20% of the pre-issue capital can only sell up to 10% under the OFS category of these IPOs. This is being done to discourage IPOs with the sole purpose of giving investors an exit. Also, this is expected to encourage companies to raise more growth capital in absence of large OFS element. SEBI has also said that anchor investors getting allotment will only be allowed to sell half of their stake post 30 days of listing, and they will have to hold on to the balance 50% of the stake for another 90 days. This should limit the typical selling overhang for a lot of these companies and also demands more skin in the game from these anchor investors. The last change is with respect to how companies use the IPO proceeds. Last but certainly not the least, in IPOs where the issuer hasn't identified the inorganic target, the issuer will only be allowed to raise 25% of the total size towards the objective of inorganic growth. Also, these issuers will only be allowed to raise 35% of the total size towards general corporate purpose. This should ensure better disclosures with respect to how these companies want to use the funds which they raise through these IPOs. All in all, these new rules from SEBI should lower the frenzied temperature around the IPO market till recently, which also ensures that more transparency for investors and responsibility for issuers and shareholders wanting an exit out of these companies.